Before we begin, if you want more independent analysis on global markets, please subscribe, and let's dissect what the UK autumn budget really means for your investments in 2026. The UK just unveiled its 2025 budget, and investors worldwide are watching closely. In this video, I'll explain how the budget could reshape UK bond yields, stock valuations, and whether now might be a good moment to reevaluate your portfolio if you have UK exposure. The budget aims to advance the UK economy with a fiscal plan balancing public debt, taxation, and growth, creating a new fiscal headroom buffer of roughly 20 to 22 billion pounds against fiscal rules. This effort to stabilize borrowing and reassure markets has shifted the tone for both bond and equity investors from fear to cautious optimism. Importantly, the budget arrives as global interest rates, including those in the UK, may begin to fall in 2026, according to leading economists. According to Goldman Sachs research, with expected interest rate cuts by the Bank of England, possibly starting in December and continuing into the first half of 2026, yields on 10-year UK government bonds, or gilts, could fall. These yields could drop from around 4.45% now to approximately 4.0 to 4.25% by the end of 2026. Lower yields typically lead to higher bond prices, potentially making now a good entry point for bond investors, especially those holding for the medium to long term. This yield rally extends beyond bonds. Falling yields often reduce interest rates across the economy, supporting mortgage markets, property, and dividend-paying equities. These factors act as catalysts for a broader market bounce, indicating potential growth across various sectors. Domestic-focused UK firms, particularly mid-caps, utilities, and real estate trusts, have recently underperformed due to macro uncertainty, but this trend is beginning to reverse. Analysts note the dividend yield gap between UK mid-caps and the multinational FTSE 100 is historically wide, suggesting mid-caps are potentially undervalued and attractive. This is especially true if bond yields fall and interest rates soften, making them appealing to investors. Lower rates benefit sectors sensitive to financing costs such as real estate, property companies, utilities, and consumer-heavy firms. These sectors could see growth in higher valuations as credit becomes cheaper, driving market performance. The budget alone doesn't erase structural challenges. Borrowing remains elevated, and public debt is close to 100% of GDP, which is historically high. This is a concern if global rates rise again, potentially impacting the UK's fiscal stability. If inflation unexpectedly rises, the Bank of England might delay or reverse rate cuts, which would push gilt yields back up and hurt bond prices. On equities, consumer demand remains fragile, and tax changes under the budget may weigh on household income. Furthermore, global economic headwinds like slower growth, geopolitics, and commodity shocks could dampen investor appetite for risk. Consider medium-term gilts or bond funds. If the Bank of England cuts rates and yields fall, bonds could deliver strong returns. Focus on dividend-heavy, domestic-oriented UK stocks, as mid-caps and sectors like real estate, utilities, and financials may outperform under lower rates. Balance risk with cash or short-duration debt, keeping a portion in liquid assets for flexibility and hedging against volatility. Diversify globally. Do not rely solely on UK equities. Combine with global equities and bonds to mitigate local risks. Stay macro-aware. Watch inflation, Bank of England communications, and global growth, weaker dollar, and commodity trends. The UK Budget 2025 changed the tone from panic to cautious optimism. For bond and stock investors, especially medium-term, the coming 12 to 18 months could present a rare window of opportunity. If you found this useful, please subscribe. It helps me deliver more timely, in-depth analyses like this. Stay alert, stay diversified, and let's see where the markets go next.